And when you said about the best investments, that even if the management would have been not the best, but the companies would still perform the best. So when you are evaluating any investment opportunity, can we break it down with some examples of what are some factors you would consider on the quantitative side as well as on the qualitative side before investing in the company?
See, clearly the quantitative side, see, you have to decide whether, I think it's very clear. You have to decide whether it's a cyclical company, whether it's a steady company, whether it is a turnaround company, whether it's an asset backed company, or whether it is a concept stock. So if you are wanting to buy a concept stock, let's assume you were trying to buy Google 20 years back. You should know how to look at a concept stock like Google or Facebook 20 years back. If you're not capable of looking at it, you shouldn't invest in such companies. So if you're buying a steady company, you should know you're buying a steady company. If you're buying a steady company, you should know what valuation you're playing. If you're investing in a cyclical stock, you should know where you are in the cycle. Are you buying it at the top of the cycle, bottom of the cycle? If you're buying it at the bottom of the cycle, you are in very good shape. If you're buying at the top of the cycle, you're making a mistake. If you're buying a turnaround, you should know how to evaluate the turnaround. Sometimes turnarounds never happen. The turnaround takes 30 years, or it may never happen. The company may just go bankrupt. So you have to know what kind of a company you're investing. Suppose you're buying an asset-backed company. You have to know whether that asset-backed company will ever sell the assets or never sell the assets. So you have to know what kind of a company you're investing in. And based on the kind of company you're investing in, you have to follow a right strategy.
So can we break it down into these companies that you just mentioned, 4 or 5 types, and let's take an example. So for example, if it's an asset backed company or if it's like a concept company, so is there a framework that you have before investing in these companies? If we can just break it down.
Absolutely. I think a
Yes.
concept company only one set of investors should invest in. So, suppose I'm a technology person and I understand that technology, and then I'm doing concept investing in that technology. Let's suppose I know e commerce and I am looking at an e commerce concept stock, then it's okay. The problem in India is suddenly you may not know anything about e-commerce, and then you start buying an e-commerce concept stock, then the chance of losing money is very, very high. So when you end up, suppose you are trying to buy a solar company, which is a concept stock. If you don't know anything about solar and you're trying to buy a concept stock in solar, you run a lot of risk by buying that solar stock. Suppose you're buying a drug discovery company and it's a drug discovery company. Again, you're buying a concept stock and you know nothing about drug discovery. Again, in all these things, actually, you're buying blind. The chance of you losing money is very, very high if you don't have any capability to look at stocks in that area. So I would say concept stocks are best avoided by most investors. But if you're a specialist in that area and then you're buying a concept stock in that area, that means you have some sense in that area. You have the right, some chance of right to win. So I don't think people realize that. They want to buy concept stock outside their what Warren Buffett calls circle of competence. You have to have a circle of competence to invest in concept stocks. But if you're talking about asset-backed company, let's say you're buying an asset-backed company, you know what is the asset it is holding, and then you have to assess whether that asset they're going to sell, whether the promoter is going to sell that asset. Suppose that asset is, let's say, a piece of land that the company owns. You have to judge whether that company is going to sell that asset, which is that piece of land. How are they going to sell that? Whether they're going to do it, when they're going to do it. Do you think the management is interested in selling that piece of land? These are the questions that company has to do. And are you willing to go to the annual general meeting and ask that question? Are you willing to write to the management and ask that question? Because in asset backed companies, sometimes the return will come only when the asset is sold. Otherwise, you may not get the return. So that's the kind of framework that you have to think about.
If you learned something new from this video, do share it with your friends and subscribe to this channel so that we can bring you the best content possible. Also, if you want to watch this entire episode, click on the link in the description box and you can go to Kushal Lodha YouTube channel and watch the entire podcast episode. Thank you so much for watching this and have an amazing day.